Hi everyone, Rosie here. So I've worked with IFRS in practice for many years now, and I've also marked professional accounting exams. So on this channel, what I do is break down complex accounting standards and explain the real logic behind them so they actually make sense for you in your SBR exam. So let's go. Hello, welcome back to SBR Technical Deep Dives. I'm Rosie, Fellow of ACCA and Head of Technical Accounting and everything IFRS. And today I am talking to you about NCI measurement, non-controlling interest measurement, and specifically the choice between fair value and proportionate method. It is one of those topics that can sometimes look complicated on paper, and I've worked with students that get a bit confused between the two. But once you understand the logic, and I mean the actual logic, not just the formula, it becomes one of the more straightforward choices in IFRS. So let's get into it. So first of all, when a parent buys a subsidiary, it sometimes doesn't buy all of it. Yeah, and someone else still owns a bit of a slice of the pie. So those minority shareholders are those non-controlling interests, and their stake has to sit on the consolidated balance sheet at the acquisition to show that fact that we don't own it all. The question IFRS 3 asks you to answer is, how do you value that slice of the pie on day one? And actually, IFRS gives you a choice. It's one of the rare, genuine accounting policy choices under IFRS. You can choose method, deal by deal, acquisition by acquisition. Now, option one is the fair value method, sometimes called full goodwill. And option two is the proportionate share of net assets, and sometimes that's referred to the partial goodwill. So we could have the same acquisition, but two valid answers. Okay, and the method that you choose changes your goodwill figure every time. Think of it a little bit like buying a house with a friend. Say you put in 75% and they put in 25%. That house is maybe worth 700,000. You both agree on that. But how you value your friend's share, well, that's where those methods do differentiate and diverge. And in accounting, that difference does matter. So under the fair value method, you value the NCI at what someone would actually pay for that minority stake in the open market on the acquisition date. So this analogy usually clicks with the students that I mentor. So imagine a premium coffee shop chain. There's a massive buzz about it. People want a piece of it. It's got a great reputation. If you own 25% of that chain, your stake isn't worth just 25% of the chairs and the coffee machines. It's worth 25% of the whole business. Yeah, the brand, the future earnings potential, everything, including the goodwill baked into what that business is worth. That is the fair value method. The NCI gets a share of goodwill because you're measuring their stake at what the market says that it's worth, and the market prices in goodwill. So under the full goodwill method, the goodwill figure on your consolidated balance sheet is bigger. It represents the full premium paid for the whole business. And that includes the parent share and the NCI share combined. Full goodwill, both sides of the acquisition in there. Now let's go to the other method, the proportionate method. And this takes a different view entirely, okay? So what you think here is, well, the NCI didn't pay a premium for the business. They're just here. So what we'll do is value their stake at their percentage of the identifiable net assets, all the tangible stuff, the things we can actually point to and measure. So back to that coffee shop, under this method, instead of asking what the market would pay for the minority stake, you just look at what the business actually owns, the equipment, the leases, the inventory, yeah, all of those things, and give the NCI their 25% slice of that. There's no premium, there's no goodwill for the NCI, just their share of what's there. So the goodwill will appear smaller on the balance sheet because it only reflects what the parent paid over and above their share of the net assets. The NCI's portion of any goodwill just simply isn't recognised. All right, it's a partial goodwill. It's the parent's premium only. Now, here's where the choice has consequences that run beyond acquisition day and into every year after. So if that goodwill is subsequently impaired, if it turns out the business isn't worth what you paid, who takes the hit? Now, under the fair value method, both the parent and the NCI recognise goodwill. So both take a share of the impairment loss. It's split between them proportionately. Yeah? It's like the coffee shop turns out to be less valuable than everyone thought. Both shareholders feel it. Yeah? However, under the proportionate method, only the parent recognised goodwill. So only the parent takes that impairment hit. The NCI sits it out. They never had any goodwill on the balance sheet to begin with, so there's nothing to impair on their side. It's the same bad news, but it's different people absorbing it and depending on the method that was used at the acquisition date. So if I had to sum up the entire difference between the two methods in one sentence, this is it. The fair value method says the NCI is a full participant in the business, goodwill and all. The proportionate method says the NCI is a shareholder in the net assets, nothing more, nothing less. Under IFRS 3, neither is wrong. They just reflect a different view of what minority ownership means. Okay. So 2 things you need to do the moment you see it in an exam question. So firstly, what's the method they're using? The question's going to tell you. You won't be asked to guess. If it gives you the fair value for the NCI specifically, it's the fair value method. If it only gives you the net assets and the percentage, it's almost always the proportionate method. All right. But don't assume, always read the requirement. It will give it to you. Secondly, know your goodwill formula for each method. In your sleep, eyes closed, memorize it. Yeah. Under the fair value method, consideration plus NCI at fair value minus fair value of net assets. Under the proportionate method, consideration minus the parent's percentage of the fair value of the net assets, and write that formula first. Then drop the numbers in. Trying to remember the formula while doing the maths is where marks get dropped. And if impairment comes up in the same question, always check which method was used at the acquisition before you decide how to split that loss. Okay, because the method that's chosen determines the answer every single year afterwards for that impairment. So let's pull it all together. IFRS 3 gives you a genuine choice, fair value or proportionate, and the business can decide deal by deal. Fair value says NCI gets a share of the goodwill, bigger NCI on the balance sheet, and impairment is shared. Proportionate, on the other hand, says that NCI only gets their slice of the net assets, smaller goodwill, smaller NCI, and impairment is all the parent's problem. The coffee shop analogy is the thing I would remember here. Full participant in the business, fair value, shareholder in the assets, proportionate. All right. Hopefully that helped, and I'll see you next time for another deep dive.